Thursday, May 28th, 2020, Monaco 64, home of alternative economics and contrarian views. So the title of the video today is "The Exploding Debt is Making the Stock Market Great Again." Before I go into the subject though, let's quickly look at the markets, what they're doing. We've had huge gains in the stock market the last few days on the back of hopes that the recovery from 2 months of economies being shut down is going to be a good one. I doubt it, of course. I think people's psychology is going to be affected for a very long time, and we're not going to see things go back to normal anytime soon. So let's first look at the markets, though, this morning, see where they are. It's 8:30 a.m. London. We've got spot gold recovering a little bit here. We've had very volatile last few days. Gold yesterday traded below 1700. Right now we're at 1720, up about 12. The high's been 1722 and the low has been 1702.73. Silver, yes, has outperformed gold. It's not outperforming gold this morning. We're at 1733, up about 9 cents or 0.5%. The gold silver ratio, though, as you can see, is now below 100. So that is a good sign, of course, for precious metals. The Dow future is up another 200 points. Does it matter with all the debt and inflation that's being created? I think it was Jim Sinclair who once said, you can't fight the Fed if they're creating a lot of money. So it looks like they're succeeding in getting the stock market higher. But the flip side of it is that the general public in the US is going to pay for this. And how are they going to pay for this? Through inflation, through a higher cost of living. As you see, when I look at the debt and the stock market, it's not going to trickle down. And you'll see who owns most of the stock market in the US, at least. So yeah, that was up 0.85%. The currencies are fairly steady. We've got sterling up 0.1 at 122.73. We've got the euro back above 110, of course. Right now we're at 110.08, unchanged. The dollar is up slightly versus the yen at 107.83. Crude oil is down 3%, WTI. We're retesting that 30 area. We're still at 31.80 though. The other thing that points to an economy that's still not picking up, but I guess it doesn't mean that the stock market can't keep going up if the Federal Reserve keeps buying all these bonds. And what does that do? Well, when bonds are bought, yields go down. So stocks are priced by discounting present value. If they do that with lower rates, that value is higher, of course. I mean, 10-year yield, you'd think would be back to 1% with the stock market rallying so much as it has, but we're just below 70 basis points. We're at 0.69. So that's pointing to more and more economic hardship, I would say, for the general public. So let's look at the exploding debt and the stock market. First, of course, let's look at the debt. It's very easy to keep track of things. We've got the US debt clock here for 2020. Recently, we were around 22 trillion, or a year or so ago, we got above 20 trillion. Well, right now, we're at 25.6 trillion. That's racking up at a rate of knots. It's crazy. Beginning of the year, the debt to GDP, that's the most important one, in my opinion, to keep an eye on as well. Was around 106. Right now, we're almost at 122%, 121.88. The other thing that we need to keep an eye on is The unfunded liabilities on the bottom right, 150 trillion almost. So that's not going to go down. The other worrying thing, if you look at GDP here, U.S. gross domestic product, usually it goes up, but now it's going down. The counter is going down and the debt is going up. That's not a good mixture. And as I've said in several of my videos already recently, if we go forward to 2024, we've got the national debt now projected at almost 46 trillion, as you can see, 45.37, and that's been going up as well. Debt to GDP in 2024, 251.5% of GDP. And look at what they're forecasting for GDP in 2024, 18 trillion. That's way below the GDP that we have now. So it's amazing that the stock market has been rebounding. But as I said, in the short term, all the Fed heroin, as the former president of the Dallas Fed, Dick Fisher, said. He said that on CNBC, that the reason why the stock market was up at the time when he said that was that the Fed injected heroin and cocaine into the market. So the Fed's done that in the last few months, and that's why the stock market is going up. But the debt and the projections for GDP are telling us another story, a very grim story. So just wanted to show you as well what this debt clock is projecting for 2028. National debt at 80 trillion now. Debt to GDP at 527%. Unfortunately, they haven't got the GDP number there, but we could calculate what the GDP would be, of course. But it's not going to be much higher than it was before this crisis started. So we've got racking debts, GDP that's going nowhere or even lower. I mean, that's a cocktail for inflation. It's a cocktail for poverty. Of course, for the top 10% or especially the 1%, they'll be fine because they can protect themselves. That's why when you look at third world countries like Brazil, where I grew up, and I've got experience from this, you have a few that have all the wealth, and the great majority live in poverty, very small middle class. So that's the future up until 2030 or thereabouts, I would say, or 2028. So let's look at who is benefiting from all this Fed money printing, all the cheerleading by the man in charge at the White House of the stock market. Is he making America great again, looking at those debt figures and GDP projections? I don't think so. He's making the top 10% whole. That's what he's doing. Because if you look at, this is from the Federal Reserve Board, actually, this data. And this is corporate equities and mutual fund shares by wealth percentile group. So right now, the latest data they had, second quarter of last year, if you add 53.1% for the top 1%, plus 34.7 for the 90 to 99%, you get 87.8%. And you can see that the bottom 90 own just over 12% of all the stock market. And for those who say, wow, it's going to trickle down all this wealth creation, well, it's not wealth creation as we know. It's just a creation of that. It's artificial wealth, right? It's ephemeral. It could disappear like it did in February and March out of thin air. It's the Fed that's propping it up with funny money. But if you go back 30 years here in 1989, you would have thought, wow, the stock market has been going up. All that wealth is trickling down. Well, it's not, because the bottom 90% used to own almost 20% of all the equity and mutual funds, about 17.7%, and now it's down to 12. So, yeah, that's what the policies of the United States government, Congress, and the Federal Reserve is doing. It's making the stock market great again, or keeping it whole for the top, well, I would say the 1%. I would say, yeah, the top 1% are becoming even greater and greater with the current policy. It will be interesting to see when they update these numbers for this year. I think it's going to be a while until we get the 2020 numbers. But as you can see, yeah, it's making the top 1% especially great. The top 10%, of course, is going along for the ride. And those who are in the bottom 90%, they're going to pay for it. And how do they pay for it? Well, all the debt that they have to carry, that Uncle Sam is incurring, with the help of the Federal Reserve, who, by the way, the Federal Reserve regional banks, they're private banks, they're owned, of course, by the top 1%. So, I mean, I'm not here to talk much about politics, but I would say, you know, that MAGA hat should be make the 1% great again. Because President Trump's fixation with the stock market is got nothing to do with the general public. It's got all to do with the top 10% and especially the top 1%. Those are the people who put him in power. And he's taken everyone else for a ride with him and fooled them quite a bit, I would say, and is lumbering all this debt on the bottom 90% to keep his friends happy. And he will probably get reelected. And the bottom 90%, the people who support him in the bottom 90% will clap at that. And it's sad. That's why you need to look at the money, look at the numbers. They don't lie. So I'm sure I'm going to get a lot of thumbs down for this video, but I don't care because it's the truth. Anyway, if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.